Welcome back to The Collective Insight. Today we're diving into the commercial engine of the energy transition. For years, renewables were a set and forget infrastructure play, but as negative pricing and cannibalization become the new normal, the industry's learning a hard lesson. It's no longer enough to just build assets, you have to know how to trade them. Our guest today is the head of Power Hedging at Nuveen Infrastructure, overseeing a global portfolio of more than 2 gigawatts of renewable projects. He's leading Nuveen's transition into the next gen IPP, moving beyond the passive model to becoming a virtual utility. Pierre Bartholin, welcome to the show. Pierre, you've recently said that the standard playbook for standalone solar is broken. In a world of negative pricing, what is the one bold truth about the death of the passive infrastructure model that investors are still refusing to accept?
Well, first of all, thank you, Hamish, for hosting me today. I'm very excited to have this conversation with you. And yeah, about this comment, I think it's common knowledge that for example, Spain PV is in a very challenging situation in the sense that at some point there has been so much PV deployment onto the grid that the value of it at noon, where you have very, very strong irradiation is very close to zero, for example, during the spring season. So this is a challenge that the entire industry is facing. And that's why in the end, I think the conclusion is that, generation doesn't matter as much as before in the sense that you can be maximizing your generation, but you are definitely not maximizing your revenues. So that's where, the dynamic on how you manage this portfolio from a revenue management perspective becomes more and more essential because, as we all know, you have less and less, feed-in tariff, CFDs, and I would say government subsidized auctions and availability of, revenue schemes. So that means, we need to face the market, and to do that, we need to all become a bit more sophisticated. So I guess that's what we're gonna discuss during these coming minutes.
Yeah, really looking forward to getting into that in more detail, Pierre. I think it's a really hot topic at the moment. I think your expertise in particular, our audience will really value the insights that you're gonna share with us over the course of this conversation. Looking back at your journey from carbon markets to managing Nuveen's 2 gigawatt portfolio, what's the one lesson that's most significantly changed how you approach managing your revenue portfolio today?
That's a good question. I think to me, at least the common denominator to my career has been in terms of, commodity trading applied to the energy transition, moving from carbon trading to now renewable hedging is kind of a natural move. And in the end, it's always using the same tools. So it's all about, financial derivatives and, minimizing risk and understanding, credit risk, for example. So you can apply that to different sets of underlyings, but I would say they are the same tools that many desks across the city of London or in Europe or even, worldwide apply to their portfolio. So I really insist that commodity trading can be applied to IPPs and renewable developers in the sense that we sell a product which has a spot market and futures market with price expectations. So once you have those two fundamentals, you can be very creative and use a lot of the existing tools, across the industry.
And maybe for those that are less in the know on market trading, in power trading, could you maybe put that in more simple terms for what that might mean for those people?
Yeah, of course. So I mean, let's take an example. Assuming we have a onshore wind farm, I don't know, in Finland, let's take an example, but honestly, that can be any other countries, even in Texas or Korea. That's always the same principle. And so you have the physical generation, obviously, that needs to be injected into the grid. So that's where developers either rely on third-party licensed trader, which can, on behalf of the project or the SPV, inject into the grid. And when I mention, spot prices, that means, well, this generation, it's sold on a 15-minute basis now at a fixed price, which is set by the market. So that's your physical revenues. And if you don't have this license internally, you have this trader doing that on your behalf. And this trader at the end of the month will be paying the SPV the time weighted average of your generation. So that's your capture value for one asset. So that's the physical basis. And then on top of that, you have different financial layers. So you can assume that you have either a CFD from the Finnish government, or you can have maybe a long-term PPA for 10 years at a fixed price. And if you have this financial long-term hedge in place, that means at the end of the month, you have a swap settlement mechanism taking place, which will be, depending what was the fixed price that you agreed with your corporate PPA off-takers, for example, one of the two parties will be making a payment to the other one, which will be the day-ahead time-weighted value versus the strike price of this long-term hedge. So you have cash in or cash out. And on top of that, if you don't sell 100% of your generation to this off-taker, well, you have the merchant bit, where you can add other kind of derivative financial swaps, depending whether you anticipated some, price moves and did enter into a swap some months ago before the delivery and the actual generation.
And this is where I think, in particular, battery energy storage systems are really coming into play to get an extra level of optionality to the market that just hasn't existed. And I'm really curious, and I know a lot of our audience will be as well, about your plays into battery storage, combining it with solar in particular. You're developing a hybrid kind of structure in Italy. You've just expanded, 437 megawatt project in Texas. In terms of PPA structures and incorporating BESS into those, is there a kind of a set structure you're working to now, or is there a more fundamental change going on in how PPAs are actually structured?
Yeah, so that's a very, very complex, question, in the sense that BESS technology is new, in the sense as very new. I mean, for example, within Nuveen portfolio, we connected our first BESS asset in the Nordics less than a year ago. So before that, it was all about theory. And since then, we have about a gigawatt of BESS in the development pipeline. So that becomes very material. And that means we really, really, really had to, beef up our capabilities in making assumptions, but in different ways. On the engineering side, how do you size a battery? How do you decide, if it's collocated? What's the ratio between the battery and your PV capacity or your wind capacity? Then you have a lot of duration consideration. You can have a 1 hour duration battery, 4 hours, 8 hours in Italy. So that's many open questions. And I think what's very interesting versus how we used to do things in the industry when you had, wind, PV, is that the revenue component for a battery becomes essential, because you need to solve the revenue equation to indicate what should be the specs of the asset. So that really complexified the equation. And I insist, so before, you had a PV asset, you have price projection, you have PPA price projection. Well, then that becomes a bit of project finance, etc. But then it's pretty straightforward. Now, massively complicated. On top of that, you have collocated or standalone different business models. And that means, do you have grid constraints for charging, discharging? That depends on the regulatory for each country, etc., etc. So that becomes super, super complex. We are very proud, I think, in the team that, we work hand in hand from the engineering until project finance, including revenue management, super aligned, because there needs to be a team's effort. We cannot work in silo. So yeah, I don't know if I answered your questions, but just to set the scene. And maybe another general comment is that, do we consider that BESS are infra, equivalent investment? Yes and no. So they are definitely real assets, but BESS need volatility to become profitable. So in that sense, we cannot exactly predict long-term stable revenues for a BESS asset for 15 years. And it would be very difficult, to have a very long-term offtake from traders. So that means BESS are a bit of a volatility and optionality game. And that means, how do we as portfolio managers value BESS? And if we go back to some extreme examples and risk that we sit on in the portfolio, such as PV cannibalization, can we draw a correlation between the BESS revenue business model and your PV risk? A simplification of that will be, how does the BESS behave when you have strong cannibalization? If that happens to be almost perfectly negative correlation, well, then we're very happy because that means we can mitigate some of the existing risks that we sit on thanks to a new business model. But that also means, well, we need new ways to assess those correlation and risk, etc. Because, two different Excel models will give you IRs, but not exactly what's the diversification game with the interaction of those two in the portfolio. So that becomes complex again, and we get back to a bit the commodity trading angle, is that now we're really deploying innovative tools to quantify and assess the benefit of a diversified portfolio in terms of geographies, but also technologies. So when you mix all that you stress a bit some scenarios, how much wind generation, how much irradiation, but also how much volatility in the wholesale market, how much cannibalization of some technologies in some countries. If you run all that for, in our case, 12 countries, 4 different technologies, maybe a gigawatt of assets in one portfolio, well, what's the benefit of adding 1 megawatt of 2 hours battery in Germany? Well, maybe that's much more than the value that we identified in the original Excel modeling exercise.
And where are the most attractive places at the moment for co-location projects from your perspective in your pipeline? Where are you most excited about that co-location opportunity and why?
Yeah, that's a very good question. So I would say we are very bullish on South Europe when it comes to co-location. So maybe as a disclaimer, we are not looking at the UK, which is a much more mature market now, for the past 5 years. But clearly our focus is also to look at markets where we have extensive presence. So that will be Spain, Italy, particularly. We see them as very attractive from a revenue perspective, also because we have so much grid access through our PV portfolio. That makes a lot of sense. And going back to this, de-risking cannibalization of PV, well, if you add co-location on one side, you can reduce grid curtailment risk. You can potentially, benefit from stronger within the same day max and min day ahead spreads. So all of that is really driving our strategy. Interestingly, we will be connecting our first next BESS in Italy with co-located sites. So at the moment, we are also negotiating with the existing industrial off-taker whether they have interest in getting access to this capacity. And if not, we will simply contract the optimization or the trading of the BESS asset with some third-party traders, which, by the way, have accumulated experience from the UK expertise and history in the country. And so that's for South Europe. We're also very active in Germany, looking at more opportunities, but also in Texas, where we have significant, PV capacity already connected into the grid. We're looking at Australia. So yeah, we're pretty busy in terms of, running assumptions and validating our revenue models.
And I guess given you're active in so many markets and we've already touched on the kind of the technology and the rate of growth of battery storage and how it's integrated with existing technologies like solar or wind is just changing so fast. So I'm kind of curious, how are you assessing, when you're assessing your business case for these opportunities and just, go or no go on these investments? Are there some key kind of metrics or red flags that you look out for that others might be making mistakes wise?
Yeah, that's a good question, because in the end, as an infra investor, we're trying to fix, expected returns on investment. So that means in your equation, you have CapEx, OpEx, and revenues. So the more you can fix those items in the equation, well, the better you are, because that means, well, you have less chances of having moving IRs in 5 years or in 10 years when we potentially divest some assets. So that's, well, not some work I've done directly, but, within the team, we're currently finalizing directly a framework agreement when it comes to CapEx with some, very leading suppliers in that area. So that means, we want to have a framework for the coming 4 to 5 years with the different IPPs that we own, that we have set up, the CapEx in terms of fixed price. So that's very interesting, because we go back to commodity trading. Is there an indexation on lithium market? Can we hedge this indexation and things like that? But once we have this framework in place, well, at least the CapEx line has been set. And because we have so much potential in terms of capacity, we think that's really a competitive edge because we're not going for 100 megawatt, but rather, 1 gigawatt times 2 or 4 hours, that becomes very significant. And interestingly, this technology can be deployed in the Nordics or in ERCOT or in Australia. So that's the same set of equipment. And then, it's all about, can we fix the revenue line? So we have very interesting discussions with either established utilities, which have been trading power for the past decades, but which are not necessarily the most optimal players when it comes to extracting value from the BESS. So we also have discussions with much smaller, I would say, boutique, 40, 50 people companies, which actually have developed, in the past 18 months, very advanced algorithm to make sure they can extract value from the BESS revenue stack. But if you were to work with smaller traders, well, obviously you have an issue when it comes to, is this a bankable offtake? Because we always need to project finance those assets. So that means we also need to discuss with bigger balance sheet. Are they interested in providing us with a bit of a financial offtake, which would be relying on the physical performance of those BESS optimizers? Put all that together. Is this bankable? Can we get some debt based on this offtake contract? And is this sufficient to finance the capex deployment? So we work all in all with, our investment team and financing team, the engineering team to make sure that we have the right specs, and the revenue team where we discuss with the off-takers.
Is that quite a common issue then that you experience, where the kind of bankability, so to speak, of your trading partner?
Yeah, because this, in the end, it's always the same. Whether you take a PV asset, a wind asset, or a BESS asset, well, if you don't have a bankable structure, you won't get project finance. Well, that doesn't fit our business model. So it's actually the highest criteria in the list is these bankables. Can we take a credit risk and performance risk on the off-taker? So that's very easy when for a PV asset you have a GAFAM, which is securing a 10-year fixed price for the power. But for BESS, there are new structures that we're exploring, and also complexities that, when it comes to BESS, you have different revenue pools, whether it's on the day-ahead market, on the ancillary market. So do you want to fix a value for all those markets at once? That would be a tolling agreement. Do you prefer to have a floor, but that's less certainty? Do you want to go merchant, but then you have less debt because, you have less previsibility on the cash flows? So we need to run models and analyses to get those answers.
I think that's really interesting. And I guess before we move on maybe to other areas of PPAs and other markets, I'm curious, something that our listeners can kind of take away. You've got great experience now across these co-location assets. You've got actual, 12 months of operating data to see how these perform. If you have kind of 2 to 3 lessons that you could share with our audience that they should go away and think about, I'd love to hear your thoughts on that.
Maybe one conclusion is, again, how to look at the asset. So it's very different from our traditional technologies in the sense that, if the market value is there, maybe the idea is not exactly to run a steady business model of 1 cycle per day for the coming 8 years. So we capture value there and there. Maybe it's time to run the asset as much as you can for the coming 2 years. And the payback period will be much shorter because the biggest concern that we may have is cannibalization of the BESS revenue in each of those markets. So I would say the time to market for this technology is even more important than for the others. So the soonest we connect, on paper, the highest the revenue expectations, but we need to be super reactive and not just, to give a bit silly constraint to a trader for the coming 5 years. That doesn't make any sense. We need to work with the traders so they can extract value as soon as they can. And in terms
Super interesting.
co-location, it's all about mitigating risk. So all the prep work on the duration, the sizing of the battery, that's essential, but you need to consider obviously your PV site along the best opportunity as a whole. And to us, when most of the cases we divest the asset, we actually prep for the future by installing a mitigating tool, which is the co-located BESS.
Really, really interesting. And I guess how does AI or technology in that space fit into that planning ahead? You're talking about prepping assets for sale, about maximizing these co-located sites. How is AI and the huge technological advancements with trading and platforms fitting into this really complex market you're in?
Yeah, I would say we are influenced by AI more in terms of how is the trader of the asset relying on AI to do market modeling and all that. Because in the end, we outsource the optimization of the asset on the market to a third party. So we need to make sure that this team is overperforming. What's interesting in the business model of BESS offtake is that in the end, we want to be quite flexible on the selection of the optimizer because we need those to overperform all the time. Interestingly, you have, some clauses to be able to swap with a new optimizer if there is constant underperformance for, 3 months, 6 months versus some benchmark. Because in the end, it's a bit of a zero-sum game. You will have the best traders and the less good traders. So we want to keep this flexibility to go only with the best ones, but I mean potentially swapping for the off-taker from time to time. So it's all about benchmarking them. And that's where in the market we're really seeking for third parties able to provide what should have been a decent trading performance for our, tech specs for the assets, so we can assess the performance of the traders.
Thank you. That's really cool. I guess looking at the broader market, the broader renewables sector that you're in, you're not just looking at implementing co-located sites, you're not just looking at battery storage or solar. You're involved from assets in development and construction through to older assets that have been in the ground for a while now. I'm really curious, in particular, for those older assets where perhaps they've had subsidies in the past, where perhaps those subsidies are coming to an end. That's a real inflection point in the business case for a lot of these projects, and it's only becoming more and more relevant. And a lot of our members in the community, the Triton Collective community, are experiencing, their assets getting towards the end of their subsidy periods. How are you approaching that, and what are the key themes you're looking out for or things you're trying to achieve when contracting PPAs for the later end of an asset's life?
Yeah, that's a good question. Yeah, because that's a real business case. When you have some assets in Italy coming to the end of the GSE floor mechanisms. If you go to Germany, obviously some even offshore wind assets are entering into a very low floor EEG support mechanism, which is well below the market. So that means, okay, what do we do now? We had some very strong, stable cash flows with a lot also of protection embedded. So, no exposure to negative prices and these kind of things, or even, grid curtailment compensated. So what do we do? Because you go from the most secured, offtake structures to becoming fully merchant. Also, sometimes a fleet which is a bit aging, 12, 15 years. So how we deal with that within Nuveen, it's all about anticipation, because in the end, to negotiate PPAs either with corporate off-takers or with traders, that takes time. It's not a 3 months easy process. It can take up to a year, even 18 months. It really depends. So it's a challenge. We need to anticipate. We need to assess what's the value. Is there a best timing to go to market, to execute? Maybe we're going to discuss the existing context of the Iran war, but that's moving a bit some curves. So there is a momentum to execute some stuff. So it's not easy. We always also go back to financing consideration. Do we need a refinance? Because you can assume that if it's the end of a finite tariff, well, maybe the financing was super tied to this one. So again, it's a joint effort. And assuming that you might be divesting some of those assets, well, what is the market expecting in terms of revenue of take structures from such asset? What's the appetite? Are there some potential buyers looking for merchant assets, very contracted? So that depends on their profile. So there is no straightforward answer. Maybe one key consideration for existing assets is that you lose the additionality concept, which is sometimes super important for some industrial off-takers, which only want to have new assets to be contracted through PPAs. So you lose a potential pool of demand on that side. But then, you have a lot of very active traders that can offer you some very innovative structures. So yeah, depends. What are your needs?
I think the structures point actually in the balance between merchant risk that you retain versus set prices that you negotiate over varying periods. I think that's a really interesting dynamic that will vary a lot between different investors and their risk appetite. What is there do you have a preference and in terms of the volume of merchant risk you're willing to take? Particularly relevant right now when you look at power prices surging in the wake of the Iranian war.
Yeah, so you can focus on two different items. One is there is the SPV and the project level. So do we have some targets in terms of looking forward basis, how much contracted value do we need? And then sometimes you have a portfolio consideration, because if this asset is part of a dedicated fund or an IPP, well, maybe you are massively contracted on all the other assets, which allow you to be a bit more flexible and a bit more merchant on this specific one. So maybe I can walk you through how we approach that within Nuveen. Is that we have energy risk management policy and philosophy in place, which a bit dictates how much we want to be contracted on a 5 years, 7 years, or even 3 years looking forward basis. And then what's very interesting is that we should always differentiate the concept of contract, or let's say being contracted versus being hedged. So if I give you an example, you can have a EEG contract with a floor for the coming 10 years. But if the floor is well below the market capture value of your asset, well, maybe you are 80% contracted, but you are only 40% value hedge on the coming years. So you can use the contracted value as an enabler of project finance, but that doesn't necessarily translate directly into, well, I'm fully hedged, I'm good. That's not true. So we always look at those two key concepts. So if I were to give a number, we always stay within a 60% 5 years looking forward basis hedge in terms of value. But I would say we are more contracted than hedged because we have those floors. You can be quite creative, you have fixed price, but you can get some colors where you have a floor and a cap. You can get some indexation. I mean, yeah, that can be very, very creative. And that's also, going back to the point of systems. We need very strong systems to assess all that, because running all that on Outlook and Excel, I mean, that's quasi impossible. So that's why we're also onboarding some tools, like ETRM to understand what are your positions. So that stands for energy trading risk management. We also have some portfolio management risk analysis tools when you can run some what if scenarios. So what if we sign a new PPA? That move, the diversification effect of the portfolio and things like that. So we have, quant background profiles in the team, can really, really deep into risk assessment and how we mitigate those risks.
Fascinating, and I think it's clear you've got the ability to really go deep, and actually, all the tools you're onboarding, the level of breadth in your portfolio, it's enabled you to to build a team to really get into detail on this. How have you structured that team, and what's led you down the path that you're at as a business to be this active? Because there are a lot of investors out there that will just say, well, we've outsourced our trading to someone else. But you've really taken this kind of decision to bring in-house this expertise and really get that extra bit of value delivered in-house. Why is that, and what's led you to go down that path?
Yeah, that's a good question. I mean, it's been a very interesting journey in the sense that, and I'm talking for, the broader industry. So we went through from an easy life, what we discussed, feed-in tariff, fixed price, you maximize generation, you maximize revenues. Well, that's fine. Now, you already mentioned negative prices, cannibalization, grid curtailment risk, Iran war, gas disruption, and stuff like that. So that becomes crazy complex. So how we navigate around that. So over time, I think we shouldn't forget that the key focus of at least my team is to secure revenues for the portfolio. So that's a basic. So we spend a lot of time originating long-term hedges, PPAs with traders, with industrial off-takers. We answer, RFQs from chemical companies or pulp and paper. So that's one. On top of that, you still have a lot of auction potential. If you go to Italy these days, you have the Fair X with very healthy pricing levels, energy release. You still have EEG available in Germany, et cetera, et cetera. So that's more on the regulatory side of things, but that's definitely a pool of long-term hedge which are available. So this is the core of our responsibilities. We need to secure long-term hedges to secure long-term financing. A bit insisting, those long-term hedges are usually a discount to our merchant expectations in terms of revenues. So that means we accept to lose a bit of value to secure financing. And then when you run some unlevered versus levered scenarios, that's where you see the upside. And also you massively reduce downside in case of, very low power price environment. But then that's our bread and butter. So where do we think we can generate alpha? It's really everything which is not long-term contracted or long-term hedged. Well, just, signing a PPA and forgetting about your merchant exposure. I mean, that's from the past, and that's where you get massively hit by cannibalization, low wholesale price environment, etc. So we actively and proactively, manage those positions by doing some short-term, derivative hedging. So today, if we think that the Q4 26 prices meet some of our, decision triggering prices, like do I need to serve debt? Do I have a dividend target linked to that asset or things like that? Well, there is no reason that we don't lock in a price. And we always refer as very, hard facts, DSCR, dividend target, and things like that, because that helps us to take a decision to hedge. In the end, what we don't want to be responsible for is to have a view on the market. I mean, I don't want my decision makers to say, well, is it better to sell today or tomorrow? Well, I don't want really to bear this decision because we are not doing prop trading, we're doing hedging. So as long as we can secure budget, we take the value where we find it. And in that sense, we work super closely with our commercial management teams because they are the ones, holding the models and knowing how we need to run the asset. So as long as we make sure that we don't overhedge in terms of volumes, not to take any volume risk, that's how we secure bit by bit our 26 budget, our 27 budget, et cetera, et cetera. So that's where we think there is a lot of alpha. And then the other thing is really about system and, quant profiles capabilities to look at things differently. Risk mitigation, diversification of the portfolio. What do we need to add? What do we need to buy? What makes sense versus the existing portfolio that we have. So that's, very interesting discussions that we have with our IC because all of that is kind of new and that's coming from the commodity trading world in the end.
I've really observed that from the Nuveen team since, we've been supporting, Neptune has been supporting Nuveen in the management of your offshore wind portfolio. And we've really kind of observed, I think, how active and how much detail focus there is from the team about squeezing every last drop of value. And it's a really refreshing approach and something that we're really trying to advocate for in the broader industry. So really applaud you, Pierre, what you're doing with your team broadly in Nuveen and doing what you can to really extract the most amount of value from these projects. Because it's ultimately how we're going to deliver the energy transition is by squeezing every last green electron, every last dollar, pound, euro from these projects to reinvest in new projects. So it's thanks to you and people like you really pushing the boundaries of our industry that's going to help us get there faster.
There is definitely a very positive feedback loop when we look at assets to be acquired or to be developed, or because everything we learn underground from assets under management, sometimes stuff happen, we can do mistakes or we didn't see that coming. Well, the feedback loop is super positive because whenever we look at same technology in the same country, well, we know exactly where we can get burned and vice versa because we support in terms of due diligence on potential acquisitions. Well, we get access to a gold mine of information. How our PPA structures, does that make sense? Oh, that's actually a very good idea. So maybe we can also transfer that to the assets under management. So I really don't underestimate the positive loop that we're creating between assets under management, assets to be acquired, and assets to be divested also, because we get a sense of what is the market looking for in terms of offtake.
Great. No, that's really, really helpful. Moving to our tradition towards the end of our podcast, we have what we call the Trident Close. If you were to give just one piece of advice to a peer, fellow investor, perhaps an investor going through a high merchant exposure or commercial revenue price crisis, what would there be one piece of advice you would give to an investor to capture that opportunity?
Yeah, I think, well, for any of our peers, it's not too late to get equipped with such a team. I mean, you have a lot of, people from the utilities, etc., that know exactly how to manage those portfolio. Because in the end, as you introduce, we tend to, lean towards a utility-like business model. So I think you have a lot of profiles that can do that. But you really need to have, the mindset to be super open to, well, great new ideas, new ways of looking at things. Because again, applying the same recipe as from the past 10 years, that doesn't work in the world we are in. And maybe to comment a bit on what's happening these days with this war. It's been 2 weeks now. In the end, to us, how we react to that is quite happy that we anticipated all that, in the sense that we already have a way to hedge each of the assets when you have some hedgeable volumes left. Looking at Q3, Q4 power prices, even now Q1 27. Well, it takes a lot of time if you start today to try to sell those volumes if you don't get market access and stuff. So to have that ready and sometimes to wait for occasion to happen, that's when you want to seize opportunity, but you need to be super reactive because markets are very, very reactive. Hopefully, the war ends and then, all of that will vanish, but you will have had a window of opportunity to capture a bit more value from the market.
So important. And this is something, we consistently see across the Trident Collective community, is those that are super active, that have the ability to really capture these opportunities and are involved in the detail. They're sweating the small stuff in their portfolios. They're the ones that are able to capture the opportunities. What we often see is the super lean teams that take direct investment approaches in these projects don't have the resources or expertise to be able to really capture this. And as a result, the opportunity passes you by and you end up stuck with your original case, which may be acceptable to you, but there's a lot of value being lost or not captured as a result of that approach. It's, as I said to you, it's a really great to see Nuveen taking such an active strategy here and being kind of at the front edge of our industry as we move into far more dynamic times, and merchant risk and hybrid projects come to the fore, a much more complex environment. So thank you so much, Pierre, for sharing your insight, for sharing your experience across the Nuveen portfolio and giving our viewers some interesting ideas to take away and maybe reflect on in their own portfolio. Great to talk to you. Thanks so much for your time.
Well, thank you, Hamish. Thanks for the collective. That was a very interesting exchange.